And again, if you think about it, it affects those that have debt.
Punishing people, it feels like, to stop them from spending seems like a weird thing to do.
You're listening to the Financers Podcast.
1, 2, 3, listen.
Right. Welcome to another episode of the Finances. It's probably been a little while since I've had Jay and I back recording, so good to be back. And I'm doing the intro for once, which is a bit weird. So, are you okay being on the other side of it?
I'm totally fine being on the other side of it, Ben.
That means today I'm going to hit him with some of the questions, see what he's been thinking about, see what's topical. So again, we'll just do a bit of a short one today, hitting on a couple of things that have been floating around in the news this week and probably generating a little bit of concern for people. So we'll give our view, maybe some little takeaways and some actions for people to look at as well. So again, this one, and I don't really like jumping at shadows. So it's just something that's probably in the news, and you can sort of get a sense sometimes when the politicians start just drip feeding little bits of, oh, we might be looking at this or we might be looking at that there's a fair chance they really are well underway of trying to trim something or make it change. So there was a bit of a discussion this week around capital gains tax and the discounts applied to that, which I think created a little bit of concern, a little bit of hysteria. But I suppose we just wanted to just briefly, in layman's terms, talk about maybe what is capital gains tax. So maybe if you want to give your quick intro on what is capital gains tax.
Yeah, and maybe just before I say that, or touch on what capital gains is, this conversation around the removal of some of the concessions with capital gains tax has been floated a number of times previously, but it feels as though it's probably got more legs, which is what you said. And so it probably forces us to, or anyone out there, to start to think about, how might I have to sort of alter my situation or react if they did in fact bring in a change to the capital gains tax concessions. Listen, in simple terms, what is capital gains tax? Well, first of all, what is a capital gain? So a capital gain, you think about it, if you buy an asset, generally speaking, an investment asset, you purchase it for a certain price. We buy it with the intent that it's going to grow in value over time. The difference between what you paid for it and what you ultimately, let's say what you sell it for, is the gain, is a capital gain. So when we talk about capital gains tax, there's in Australia we pay tax on the gain, the difference between what we purchased an asset for and what we sold it for, with some concessions. The concession that exists at the moment is that, and there's some nuance to this, but if you've held an asset for more than 12 months, you get to cut that gain in half and be only assessed on half of that total gain. So in really simple terms, the difference between what you bought an asset for and what you sold it for, that is the capital gain, and capital gains tax applies to that amount or the discounted amount depending upon how long you've owned it for. Is that a simple enough explanation?
I think we just disclaimer in terms of it depends on a multitude of factors, ownership structure, etc.
Correct.
In simple terms, that's the easy way people look at it. You own it for more than a year, there's a capital gain, you reduce the assessable taxable gain by 50%. Now, that's where they're, at this point, flagging some potential alteration, which probably affects a lot of people, affects most people that are investing in some way. So it's important we understand what that means. Now, the key thing I would say is that it's almost like they test the waters from a political sense to see like how much backlash will we get over this, because if you go back to previous times with tax changes around franking credits and things, it was sort of political suicide and probably cost one party an election probably nearly a decade ago. So potentially this actually never happens or does not happen in the short term, but we want to make sure that you're aware of it, we're conscious of it, we'll tell you if there's any need to make changes, but I also get worried when people start to make changes about just floated things, because there's so much room for this to alter or not occur at all. So I think being aware of it, understanding it, what could it be, but we don't want to see a rush of people starting to, sell properties or sell assets to try and beat this change. It's likely to drag out for a while.
Anyway, that's the question: did they float it, or whether it would be grandfathered?
Well, that's the thing. That's the other side. Is it for only assets purchased new? Is it got a date of coming in from the 1st of July 2028? All these things need to be clarified. So, yeah, there's a lot of water to go under the bridge, probably politically as well as just factually with these things. So, again, I think it's important just to understand it, be aware of it, people overreact. And if anything, I think with investing is if you can avoid that emotional reaction, that's probably what's going to serve you better in the long run, whether it's a tax change, a change from government spending policy, anything really. If you can just not be too reactive to things, that's usually what's going to serve us pretty well. Systemized, repeated, process-based.
And even if we're unsure about what the change is actually going to be, I like the idea of getting ahead of the curve. So that, like in simple terms, that is, if you've got assets that have got unrealized gains, you probably should at least be talking to someone like us and your accountant and making sure that you've got, we like to line our ducks up so that as a change happens, you don't act emotionally. You can just objectively say, yeah, this is what I need to do. So if you're in that situation, come and talk to us.
I think that the only, and we won't go into too much because it's probably more speculation and guessing, is sort of why they would do this. Like people go, well, why would they do that? Well, there's probably two clear components. There's two parts of it. Probably the first one is revenue. So if you remove some of those concessions, people will pay a higher level of tax on the sale of assets, which is good for the government to get some funds back in, which they're pretty keen to do. The other side of it, if you apply it to the housing side of things, is that potentially it has the ability to maybe make property look less attractive as an investment vehicle, which if you play it out from an economics point of view, potentially brings down prices of housing because it will reduce the demand for people to buy them. Now, they've tried many times to alter the attractiveness of property or make it easier for people to access property, which doesn't always work either. Again, there's probably a few layers to it. That's just sort of surface level of going like, what are they trying to do? Well, they're trying to raise additional funds by removing some concessions, and they're potentially trying to also slow down the property market or even sort of impair it a little bit for affordability purposes. So again, that's probably a very brief reading of the tea leaves from our perspective on that. Probably sort of talking about property and houses and rolling into something else that's obviously has occurred this week was obviously the increase in interest rates, which it's probably, I would say it was a surprise, but it probably wasn't because the sort of, again, the messaging comes well before the change here, and you started to sense that I think we might be heading up again or pausing for longer. Now,
it was a surprising turnaround from what was, so you go back 12 months ago to where...
Probably 12, in some ways, almost 12 weeks ago. Like,
yes.
In some ways, it's through the back end of last year, you started to go, oh, hang on a second.
Yeah, the opinion has changed on where rates will go and what inflation is actually doing.
Exactly. So, again, obviously that one hits quickly. It's a quick change. The banks they don't pause and hang around pushing it through. So people will notice that pretty much from the end of the month onwards. Now, again, just to recap or refresh your hip, the whole purpose of increasing rates is to try and limit how much money people have left to spend on other items to try and battle inflation, which
it seems like punishing people, it feels like, to stop them from spending seems like a weird thing to do, but it's a
tool to have. It's
a tool at the disposal of the Reserve Bank and the government to limit inflation. What is inflation? I suppose why do you want to get inflation under control? Inflation, effectively, the sort of the cost of living, the cost of goods going up, puts a lot of pressure on a number of areas of the economy. And the idea is that we want to have, again, we won't go into the guts of it, but want to keep inflation within an acceptable range. And one of the levers to do that is interest rate rises.
It is. You could probably debate the effectiveness of it. And again, if you think about it, it affects those that have debt, and those who don't, it actually potentially benefits because their deposit products, their term deposits, their bank holdings actually achieve a higher level of earnings now of passive income. So I think that's more of a holistic position that probably needs to be assessed, is saying, is this effective? You could argue it was effective because when the rates went up rapidly, inflation did come down.
Well, I think it was, and we mentioned this the other day, it was almost the insinuation of rates going up.
Discussion more than
that has an impact that people think, oh, I should probably tighten because rates are coming. But like you said, those people that actually have some money, like maybe sort of retirees or people that got a decent amount of capital, they're benefiting with additional income because their interest rates have gone up and they've got greater capacity to spend. So, which is the result that which one's actually going to give us the best result? Again, like you said, it's it's probably still questionable whether or not tweaking rates up is going to give us the impact that the RBA is after.
Yeah. So again, it's obviously it's gone up. Everyone will probably be intrigued by what happens beyond this. Sort of in a sense, the market had priced it in, like it was sort of had become pretty well expected that this was likely to be a rise. But again, from our client perspective, it's something we've been talking about for a while. We've been monitoring. We've got buffers built in on anywhere where people have debt, so we know what they can cope with in tolerance. If they've just gone and taken out a loan to invest, well, we know they've got plenty of room to move, that this isn't going to change their path at all, potentially. So again, I think it's just general awareness. And again, I think a lot of people got the fright when rates went up rapidly. They probably reassessed things, and then they've been benefiting as it comes back down. Again, it's just another little tap on the brakes and a little reminder for people to know what your situation is, know what your cash flow is, what have you got coming up, plan for it. Like that's our view. It doesn't really worry me, wouldn't mind my mortgage not going up, but affects most people or a lot of people. So, but if you have an awareness, it doesn't keep you up at night. So some people it may.
What if anything do you do about the rates rising? What are some practical things that people could do? I mean, the one that comes to mind immediately is that if you haven't, most things when you have a rate rise, you go, oh shit, I probably should look at my loan. If I haven't already, I should be looking. The banks are obviously in competition with one another to gain business. If you haven't looked at your rate for a while, it's probably time. We did a bunch of podcasts earlier in the maybe last year about putting pressure on the banks to sharpen their rates. Good opportunity to do that. And if you're unaware of the impact that a rate rise is going to have on your cash flow, it probably means you don't have a very good handle on your cash flow, and you should dial in a little bit harder on what the impact would be.
Well, a lot of clients, with ones we look after closely, is that it actually may not impact them at all from a cash flow point of view, because we've maybe got them when rates went up, we locked in their payments at a higher level, and as rates have come down, they've just been paying off their debt at a quicker rate than they were anyway. So rates going back the other way maybe impacts their ability to pay down their debt as quickly, but from a general month-to-month cash flow point of view, they're still paying the same amount they were. Now, again, it's not for everyone, but some of them go, right, you could afford that, so continue to include that in your week-to-week, month-to-month budget, and then move beyond that. So again, I think when you're starting to get down to that micro splitting of hairs between if rates go up by 0.25% and that tips you over into from surplus into a deficit, like that's a bit of a concern more broadly, and there's probably a lot of other factors that need to be reviewed in that. Now, sometimes, and this probably rolls into the last bit I wanted to just touch on again, was just that cost of living pressures, which sort of ties into the inflation. It's all one and the same. It's just about, I think the biggest thing is just knowing where your money's going. Again, using technology to track it, just consciously, maybe you have to print out your statement and go through it. Just try and gather some awareness of where your money's going.
I couldn't agree more, and I've noticed more and more the last 3 months, and we'll do it selectively, but clients actually needing to have like granular level detail on where their expenditure is actually going. Now, it's a laborious thing to do. It is, right? But there is technology that we use that can help that. Like categorizing your expenses once is painful, but with automation, it will then do it ongoing for you, and you don't need to do it. And that straight away, like when we now have our reviews with clients that are on automated sort of cash flow monitoring, we're not speculating about what their expenses are, and even their income. If they've got multiple income sources, we can see exactly, and so you can then start to make much more informed decisions about which way you pivot. If rates go up, what do I need to tweak? What's the discretionary expenses in my what exactly have I spent, and what can I tweak?
The thing with that is, it's what destroys people is uncertainty. So they're pretty much always uncertain unless it's mapped and tracked and recorded. Like they can say, oh yeah, no, I think cash flow is pretty good. Oh, we're pretty good with our expenses. There's not really certainty in that until you track it, record it, write it down, look at it over a period of time. You don't really know. A lot of people will complete a budget off what they think they spend, but then the reality is far, far different. So you need to know. And then when people are uncertain, they don't usually make as good of decisions because they're not informed. So they can't make good decisions because haven't got that high level of confidence in their cash flow or their ability to make ends meet if something does change.
To me, it's hygiene, and I know it's painful, and I know that it's probably the least sexy part of managing your financial situation, but it's just the cornerstone. It's the cornerstone of it. If you get it right, you, like you said, you're informed about your situation. You can make good decisions. You won't be that emotional. You'll be much more objective with your decision making. So again, if you're listening to this and you don't have awareness around what your cash flow is, we can help. We can help put mechanisms in place and systems and automation and RB to track it, and be that sort of accountability coach to say, well, we can't stop you from spending. I can't sit in your wallet and tell you don't spend that, but we can check in regularly with what you agreed you'd do and make sure you're accountable to it. So.
Again, if that's something you want to look at, we do lots of that cash flow management using technology to assist with it. So again, please reach out and have a conversation, ask a question about what that looks like, because that's pretty much always the starting point, whether we're talking about investing large sums of money or we're trying to, get you back in the green after being in a period of red. We need to know, where's your cash flow. So no matter who you are, we're going to talk about cash flow.
How many times have you had someone do a budget and it says that they're in significant surplus, and then you look at their bank accounts and see where's that
gone?
Yeah, and it can't be explained. It means that budget is a work of fiction, or you'll see if someone's in deficit, you'll generally see a debt that is accumulating.
Like a trail of destruction.
Correct.
Because you see the mortgages, square, and then there was a credit card, there was a personal loan, and a car loan. You can see it quickly.
Yeah, how are we funding this deficit? And you see growing personal loans, credit cards. Again, if that's you, then get your cash flow under control.
And often it's not so much about what's coming in, it's what's going out. And the good thing is if you've got a solid amount of income coming in, then you can fix those problems quicker. Generating more income is sometimes challenging for people. Controlling their expenses might feel challenging, but it's a very achievable thing to do.
It is, but it takes discipline.
Yeah.
And it takes self-discipline, which, again, if you're looking for an easy answer for someone to give you just the solution to fixing your cash flow, it actually starts 100% with you. But you can get support to help you through that difficult part. It's just easy to spend these days. I mean, it's just
convenience.
It is so easy to spend, from subscription services to tap and pay to getting everything delivered. It's just easy. It's easy to spend, so it's easy to be ill-disciplined with your expenses.
Definitely. All right, I think that's enough for today. We've covered a few boring topics, tax, interest rates, etc. But hopefully there's some takeaways for it. Again, reach out to us, whether that's via any of the social media platforms, via the website. Give us a call. Again, just a quick reminder on that. We just do a quick introductory call for anyone who's wanting to chat 15, 20 minutes, understand a little bit about what you're looking for, learn what we could do for you, and sort of guide you through that process. So there's no cost on that meeting. So again, reach out, book in. Keen to chat to as many people as possible.
Well hosted, Ben.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, YouTube, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners to check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening. Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decisions, listeners should consider the appropriateness of any information with regard to their particular objective, situation, or needs, and seek advice from a licensed professional specific to their circumstances. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of Acumen Financial Planning, ABN 89051 208 327, Australian Financial Services Licence 232706.